Hello and welcome back. What if I told you that the headlines you're seeing about Canada's economy and real estate market are telling only half the story, and in some cases, actively misleading you? Today, we're going to pull back the curtain on the true state of real estate across Canada and then zoom in on what these shifts mean specifically for buyers and sellers here in Greater Vancouver. Stick with me until the end, because understanding these underlying currents could be the key to making your smartest real estate move yet. Let's begin by looking at the national picture. And we have to start with some surprising economic data. Recently, Canada's GDP print for the third quarter came in way higher than expected, rising at an annualized pace of 2.6%. On the surface, this sounds like a booming economy, perhaps signaling strength. However, when you dig into the details, it becomes clear that this growth was almost entirely due to trade, specifically a significant drop in imports. Why did imports fall so dramatically? Because Canadian households are pulling back under the strain of a weaker labor market and broader economic uncertainty. Household consumption actually fell 0.4% in Q3, marking the worst quarterly performance since the pandemic. So while the headline GDP number looks strong, it was more a technical boost from reduced spending, not a reflection of a thriving economy powered by confident consumers. This underlying weakness is why the financial markets reacted with a shrug, not a celebration. The Canada 5-year bond yield, which heavily influences fixed-rate mortgages, saw very little movement, up only about 2 basis points. Likewise, market expectations for Bank of Canada interest rate cuts remained effectively unchanged. T here is no cut priced in for December and less than a 40% chance of any cuts in 2026. This tells us that the smart money, the billions moving through the bond market, isn't buying into the idea of a suddenly booming economy. They see the same underlying problems we're discussing today. Now, how does this translate to the national housing market? While residential investment, specifically in structures, did see a rise, this was largely driven by a slight uptick in resales. However, this is not indicative of a robust rebound. Home sales across Canada remain incredibly weak, sitting well below long-term historical averages. For example, even here in Greater Vancouver, November sales are expected to be roughly 25% below the 20-year long-term average. This isn't just a Vancouver story. We're seeing similar trends in Toronto and Calgary. The most critical and often overlooked aspect of the Canadian housing market right now is the new construction sector. It is, quite frankly, on life support. Take the Greater Toronto area. We've seen month after month of record low new home sales. In the city of Toronto, an urban core of nearly 3 million people, there were just 25 new condo sales last month. Think about that for a moment. This traditional pre-sale model, where investors buy units to fund construction, is effectively dead. If developers can't pre-sell, they can't secure construction financing, and buildings don't get built. This doesn't mean we'll see a supply crunch tomorrow or next year, but it absolutely sows the seeds for a significant shortfall 4 to 5 years down the road. This year, Greater Vancouver is projected to finish with around 40 new home sales, a drastic drop from nearly 25 in 2021 and half of the previous low in 2019. The industry is struggling to keep the lights on. As a result, many developers are pivoting, converting their projects into rental units to secure financing and keep their businesses afloat. While this does add to rental supply, it introduces another layer of complexity. We're seeing a record number of rentals being built at a time when there are concerns about future immigration levels and population growth being rebalanced. This could lead to higher vacancies and declining rents in the near term. It's also important to understand the different ways rental data is presented. Agencies like CMHC track turnover rents, which show a significant jump when a long-term tenant moves out and a unit is re-rented at current market rates. However, if you look at asking rents from platforms like Rentals, CA, you'll see a trend of declining rents in real time. It's crucial to understand how this sausage is made to avoid being misled by headlines. Finally, while housing starts might appear relatively elevated, a deeper look reveals they are predominantly in the rental segment or in duplexes and multiplexes. Crucially, single-family housing permits on a 12-month basis are at record lows in both British Columbia and Ontario. This indicates a future scarcity in single-family homes, which could lead to a different recovery trajectory for that specific segment further down the road. So, while the headlines might suggest otherwise, the overall Canadian real estate market is grappling with a disconnect between technical economic data and on-the-ground realities. We're not seeing a robust recovery, but rather a cautious market with significant underlying challenges, particularly in the new construction and future supply pipeline. Now, let's bring this closer to home and unpack what these national trends, coupled with local dynamics, mean for Greater Vancouver. As I mentioned in the intro, Vancouver's real estate market has definitely hit a turning point. We're seeing prices slipping, inventory surging, and some new rulings creating uncertainty. Looking at November's numbers for Greater Vancouver, we saw 7 homes change hands. This was a 21% increase from October, making it the second busiest month of the year. This shows that buyers are still active and willing to commit when the right property at the right price comes along. However, it's important to keep perspective. Year over year, sales are still down about 14% and approximately 14.5% below the 10-year average. This is not a hot market. It's a cautious, selective one, performing better than the immediate past, but still underperforming compared to what we typically expect. The most significant headline for Vancouver is inventory. We're hovering around 15,800 active listings, which is up 13% from last year and a staggering 6% above the 10-year average. When inventory climbs this high, it's like having too many options and not enough demand. The balance of power shifts. Buyers suddenly have more choice and they're not feeling rushed. For sellers, this means you're competing with a lot more properties, and buyers can afford to be more intentional, negotiate harder, and walk away from listings that don't make sense. This shift has naturally impacted prices. The benchmark price for a home in Greater Vancouver now sits at $1,132,500. This is down 5.1% from the market peak earlier this year, marking 7 straight months of price declines. We're essentially back to pricing levels last seen in March of 2023. While this isn't a crash, it's a healthy correction of the rapid gains we saw during periods of lower interest rates and intense buyer demand. It's an unwinding of that market froth. Interestingly, while median and average prices might show some month-over-month gains, the overall trend points to softening. This means the highest quality homes in prime locations are still holding their value reasonably well. But average or compromised properties are seeing the biggest price adjustments. Quality and strategic pricing are being rewarded. Several factors are fueling this shift in Vancouver. Interest rates, while they may have stabilized, are still much higher than what we became accustomed to from 2020 to 2022. This directly impacts affordability and how much people can borrow. Buyers are doing more math and less emotional decision making. We're also seeing job growth in British Columbia slow down, particularly in sectors like construction and development, which are closely tied to confidence in housing. This contributes to a broader narrative of economic uncertainty, making both consumers and investors more cautious. Furthermore, new federal budget measures are heavily tilted towards supporting rental supply rather than directly aiding home ownership, leaving many first-time buyers on the sidelines, waiting to see how things unfold. Even the Vancouver rental market is trending downward, with a 7.4% year-over-year decrease. With more new rental inventory on the horizon, many investors are either pausing new purchases or considering cashing out, especially in smaller unit segments that were heavily investor-driven. Lower rents combined with higher borrowing costs make it much harder for these properties to generate positive cash flow. While real estate investment in Vancouver isn't dead, the strategy must evolve, focusing on specific product types, locations, and carefully analyzed numbers. Finally, a factor adding a layer of uncertainty is a recent land title decision involving Indigenous land claims. Without diving into legal specifics, a court decision has acknowledged overlapping Aboriginal title in areas that traditionally had fee simple titles. While geographically localized, this creates ripples across the province. Any time the concept of clear title is questioned, it makes buyers, lenders, and insurers pay closer attention. It's not a reason for every homeowner to panic, but it is a closely watched development for the market. So, what does all of this mean for you, whether you are looking to buy or sell in Greater Vancouver? For buyers, this is a moment to watch closely, and for some, it's a moment to act. More options, potentially more motivated sellers, and less competition can work significantly in your favor, especially if you are well-financed and approaching the market smartly. This is an environment where you can negotiate on price, terms, and even completion dates in ways that simply weren't possible during the frenzy years. If you've been patiently waiting for the market to calm down to make a thoughtful move, your patience is about to be rewarded. For sellers, strategic pricing is absolutely key. Homes that are priced correctly and presented beautifully are still moving. However, the days of aspirational pricing are gone. Buyers have more choices, and they are comparing your home against a larger inventory than they were a year or two ago. This means you need to nail 3 things: presentation, pricing, and promotion. Your home needs to look its absolute best. It needs to be positioned correctly against the competition, and it needs a marketing plan that makes it truly stand out. Looking ahead, December and January are traditionally quieter months. However, I expect a significant focus to shift to the spring 2026 market. Many people will use the winter to watch interest rates, pay down a bit more debt, and assess the broader economy. The real question is, what happens once we get clearer signals about the Bank of Canada's next moves? If markets start anticipating further rate cuts, or if we actually see a reduction, that can very quickly change buyer sentiment. Add in any new federal or provincial policies that directly support home ownership, and we could see a meaningful uptick in demand, particularly from buyers who've been waiting on the sidelines. Understanding these complexities and navigating them successfully requires more than just reacting to headlines. It demands a tailored strategy specific to your goals and the current market conditions. If you're thinking of buying or selling, or simply want to understand what this dynamic market means for your personal real estate journey in Greater Vancouver, please reach out. Let's connect to discuss your specific needs and develop a strategy that will make a difference for you in the coming months.